Last month, I logged into my credit card account, and before I could do anything, a pop-up appeared. Update your income so we can serve you better. Serve me better? Let's talk about what that really means and how to turn it to your advantage. There are 3 real reasons banks want your income. 1. Regulatory requirements. Under the Credit Card Act of 2009, lenders must consider your ability to repay before extending credit. That means opening a new card, increasing your credit limit, approving certain loans. So yes, sometimes income is legitimately required. But those mid-account friendly update pop-ups? Usually optional. When you enter your income, it feeds into 3 main systems. 1. Credit limit models. Higher income, potentially higher limit. But higher limits, increased spending capacity, lower utilization ratio, can improve credit score. It's not automatically good or bad. It depends on behavior. 2. Risk and pricing models. Income combines with credit score, debt-to-income ratio, payment history, internal behavior tracking. Interest rate decisions are usually more credit score driven than income driven. Behavior is greater than income. Always. 3. Marketing segmentation. This is where income matters most. Banks categorize you into premium prospects, installment loan candidates, balance transfer targets, wealth management leads. That's not evil. It's segmentation. Every major bank, including JPMorgan Chase and Bank of America, uses algorithmic marketing models. The more data you give, the more precise the targeting. There's a concept in finance called ability to pay pricing. It means if you can afford more, companies may charge more. But here's what most people misunderstand. For mainstream credit cards, your credit score tier usually drives pricing more than income. A 780 score with $70,000 income often gets better terms than a 660 score with $200,000 income. Why? Because payment history predicts risk better than salary does. Banks care about, do you pay? Do you revolve balances? Do you default? Income is secondary. This is where strategy matters. Update your income when you want a higher credit limit, your utilization is high, your income significantly increased, you're applying for new credit. Higher limits can improve your credit score, lower utilization ratio, strengthen your profile. That's powerful. Used correctly, income updates can actually make you more financially flexible. You can ignore update requests when you don't want a limit increase, you don't want additional marketing. You're not applying for new credit, your financial situation is stable. There's generally no penalty for closing those pop-ups. Your score doesn't drop, your account doesn't close. Life goes on. Here's what really matters. The dominant scoring model in the US is FICO, and FICO does not use your income. It uses payment history, utilization, length of credit history, credit mix, new credit inquiries. Notice what's missing? Income. Your behavior outweighs your salary. Every time. Instead of never update income, use this rule. Update when it benefits you. Ignore when it only benefits them. That's it, not paranoia. Not blind compliance. Just incentive alignment. Banks optimize for profit. You optimize for financial stability. The relationship isn't evil, it's transactional. So the next time that income pop-up appears, don't react emotionally. Ask one question. Does this help me right now? If yes, update it. If not, close it.